Hello and welcome to Investing Confidential. Everyone's watching, every market player, investor, trader, talking heads, Wall Street analysts, they're all looking for one thing. When is the Fed going to pivot? I'm going to tell you right now, pivot is not going to matter. Doesn't matter when they do it. Doesn't matter if they do it tomorrow, 6 months from now. It's not going to matter. We're screwed one way or the other. But let's talk today, right now, we're going to talk about jobs. Jobs. This is what's seeing me. It's jobs day. Look, today's data is irrelevant, folks. Don't even pay attention to it. I was a professional money manager for almost 2 decades. Anytime this job data came out, I was in a meeting. I didn't care. Professional investors really don't care. Traders care. The media cares. Wall Street analysts care. But professional investors don't care about this irrelevant, backward-looking data. I discussed a couple of videos ago about how irrelevant the data is. They need to overhaul the whole thing. Go back and look at my other video, and it will tell you that all this data, this doesn't matter. Okay, it's past, it's backward-looking, and it's flawed. Okay, the data is completely flawed, so don't worry about it. The most important thing today, and some people talk about it, is these tech layoffs. I mean, we already saw Meta announce layoffs over a month ago. Amazon. Now we've got Lyft. We got Stripe. And we got the big one, Twitter, right? Twitter's going to knock off apparently 50% of their employees. We're seeing this across the board, and it's not just technology. Everyone's saying, oh, this technology-based, whatever. No. We've seen it from the auto manufacturers are laying off people. We're seeing, retailers laying off people. This is happening across the board, folks. So these unemployment numbers that everyone's focused on, they're flawed. They mean nothing, okay? Because the only thing that matters is actual layoffs. The unemployment rate calculated by the BLS is flawed. It's irrelevant, okay? The real numbers, not 3.6, it's probably more close to 8-9%, and it's going higher. Okay, look at Meta, for example. Facebook users. Facebook is, obviously Meta's more than Facebook, but Facebook's out of business, and Zuckerberg's small enough to know that. Facebook's done. It's irrelevant. Okay, now Facebook is a landing page for Instagram. He's moving his business over time to Web3, to VR, and you know what? Over time, that's gonna pay off. Whether his company can last that long, I don't know. It's probably going to, but in the short term, the medium term, this is a dead stock, and he's gonna have to lay off a ton more people and move people over to this Web3 that he's doing. But these layoffs in tech sector are not just tech. You're seeing it in the chip sector. Samsung, Qualcomm is the big one in the U.S. These guys are suffering from weak demand. Do you know what that means? Remember 6 months ago, a year ago, the narrative, you can't buy cars, you can't buy appliances, there's no chips. Well, sure, that may have been for 6 months. Now, folks, the economy, the world is loaded with chips, okay? We got more chips than we know what to do with right now. And so, again, I say this again, don't let any dealer tell you that there's no car. Don't let anyone tell you that you have to wait for appliances. This is all a fake narrative, okay? There's a ton of supply on the market. Lumber, whether it's lumber, used cars, now chips. We're overloaded with them, okay? We're overloaded with computers and smartphones. There's no demand for this stuff because and I'll go into it later, the entire world economy is slowing down dramatically, is pretty much blown up. And let me go back to the numbers for a second on the jobs. Remember, I mentioned again. Go back to my video from last week. The hospitality sector is skewing these unemployment numbers. Okay, the hospitality sector pays nothing. Okay, nobody wants to work in a hotel. Okay, pretty much it's hotels because they don't want to pay. They want to pay you $20,000, $35,000. That's not a living wage. No wonder no one wants to. You can work, at home as a customer service person and make, probably double what a hotel is going to pay you. So again, this is a flawed system. These numbers need to be overhauled. The government is a joke. The government's full of too many people. The government needs to slim down. And therefore, hopefully, you get some more smart people in there that looks at these numbers and say, hey, they've got to change. But the unemployment rate, bottom line, is going to go like a hockey stick, okay, in a matter of months, like a hockey stick. That's going to change the way the Fed looks at things. But for now, I'll go into it later. There's nothing anyone could do. But I got to mention something now. Watch this 2-second video.
Just show phenomenal strength in the economy. David, this economy's on fire.
On fire.
Jim Cramer is a moron, okay? Jim Cramer is an absolute moron. This economy is tanking, and for him to say something like that is absurd. Okay, the guy should have no ratings. I would turn off, if I were you, every time that moron's on the television, just turn it off. He's completely out of wits. There's an ETF out there that looks at all his stock picks, and everyone's known this for a long time. But I mean, come on, this guy's saying this today is ridiculous. Especially when everyone knows that supposedly he's a professional. Oh, I work at Goldman Sachs, all this. Come on, the guy's a joke. Let's go down to the real data. Professionals look at the yield curve, right? The 10-year versus the 2-year. Okay, that's the long bond versus the short. When we see an inversion, that means recession. It's inevitable. It always happens. Look at this curve right now. There's nothing anyone could do. This tells us that we are in a recession today, or the recession is coming. It's happening, and there's no Jim Cramers or anyone else can say ridiculous things and get everyone out of it. If we look at the history, and I'm going to show you now the history of yield curve inversion, especially with this kind of intensity. Look back in history, 100%. Every single time we have this yield curve inversion, this is a forward-looking indicator, we go into a recession. 100% of the time. As you know, if you listen to my videos, I think we're already in a type of recession, but look at the numbers. It's inevitable. Why? Okay, take a look at global manufacturing. These are manufacturing orders. Okay, these are companies ordering things around the world. Gone. Tanking. Is that a sign of a healthy economy? No. Let's look at European PMIs. Okay, PMIs, as we talked about, anything over 50 means the economy is growing. Under 50 means it's a drastic slowdown. Look at Europe. Recession is baked in, folks. And this is, again, combine all of Europe together, is the largest economy in the world. Okay, it's bigger than China and bigger than the US combined, and they're tanking. This is what a lot of our companies export to, including the tech companies. So what does that tell you? Okay, what is the Fed doing now? Okay, we look back at the Wednesday meeting. The Fed's actually taking the right path, but you know what? They have no choice. Don't give them a pat on the back. They're so behind the curve. So behind the curve. They caused this nightmare. And now everyone's sort of patting them. Look at Powell's. Okay, this is an index of Powell's credibility. I don't know who invents these things, but okay, so Powell's credibility is going up. And guess what? He's watching this, and this is all he cares about. This is all he cares about. And so guess what he's going to do? His legacy's at stake. He's a fool, but his legacy's at stake. He's a court jester, but he's going to continue to be very, very negative, even though deep down in his heart, he's a dove. He's in the pockets of the private equity, but in the short term, short to medium term, he is going to continue this very, very hawkish view, which is obviously correct. But let's put this in perspective. Look at this. For example, the Fed funds rate, in terms of the delta, is the fastest since the 1980s. Okay, the fastest since the 1980s. This is significant. And by the way, it's not just the Fed. It's all central banks around the world. Here we go. Look at this. It's not that they're coordinating, because they're all morons. They're not coordinating. But they got no choice. Inflation in Europe is worse than it is here. Inflation is except for Asia, inflation is just ravaging the Western world, right? The US, Europe, most of Latin America, Africa, Asia's holding it a little bit, but they've got an inflation problem too, but it's much less. But we are getting pounded by inflation, and the central banks around the world are rising rates rapidly. It's coordinated. So what does that mean? That means the global economy screwed, folks. Okay, let's go back to the US here. Our terminal rate, we talked about the terminal rate in the past. It was, all these pundits saying it was going to 4. No, I kept saying 5 or 6. Now it's going to 6 for sure. Look at it, going to 6. 2-year rate now, 4.5%. 2-year rate. What does that mean? This whole TINA thing, there is no alternative. Throw it out the window. TINA's gone for our lifetime. Gone. We got 4. What does this mean? That means you can buy, by the way, I bought a 6-month treasury bill. A 6-month treasury bill at 4%. 4%. For 6 months. I just keep rolling it because the rates are just going to go higher. Can I get that in the stock market? No chance. Long-term bonds, why would I buy a long-term bond here? If you can get, eventually money markets are going to go 4%. Take a money market rate. Let all this volatility come down. I'm going to show you why in a few minutes, why it's going to continue for a while. But again, look what this is causing. Look at the 30-year mortgage rate over time, right? Over time. It's brutal what's happening. This is obviously affecting the housing market. Okay, now I'm going to mention really one thing while I'm mentioning housing. Look at these Blackstone people, okay? These are the people, and I think I mentioned this a few videos ago, these are the people that caused the housing crisis, folks. They caused the housing crisis. They were the ones buying thousands, Blackstone and Open Door and all these other characters, hedge funds. These are the people that destroyed the American dream, buying thousands of homes sight unseen. Not people, single-family home buyers, but these large institutions. But look what's happening now. They've got a massive fund. It's having major problems. And publicly, they're no longer buying homes. And then behind the scenes, they're selling homes. The largest owner of homes is dumping homes on the market. There are no buyers. There are no buyers because rates are normalizing. And now 30-year mortgages are through the roof. So what do you think is going to happen? You're going to see bids hit at some point early next year, and prices are going to come tumbling down. It's going to be a fire sale because a lot of these guys are holding back. No one wants to sell. No one wants to sell. And then when someone's forced to sell, that's when things are going to get really ugly. And if you're a home buyer, just sit and have patience. You're going to be benefiting. So let's talk about the most important thing I want to mention today is the pivot, okay, and why the pivot doesn't matter. Okay, so as you can see here, you have to understand what's going on, you have to always look at history, okay? If you look at the 70s, when all this inflation started and the rates started going up and Carter and all this other nonsense, first of all, it takes a long time. It's a 3 to 5 year event. But even when the central banks finally pivot, in this case, the US pivoted, okay? By that time, it's too late. By that time, it's way too late. You're in major stagflation at that point, okay? And stock prices, housing prices, everything is tanked. Everything is tanking. And there are a lot of people that are leveraged. So people say, oh, these guys on the TV, oh, hold on to your stocks long term. There are a lot of people that can't because they're levered. If you're levered, I'd be very careful right now. But so the point is that no matter when the Fed pivots, it's not going to matter. The economy is going to be already in the tank or on its way to the tank. And even after the pivot, as you can see, it's going to take a while before things recover. So if you look at the situation with our central bank, with Powell, etc., he is going to, he likes this credibility index, continue to raise rates, continue to be hawkish, and it's going to really deteriorate things for a long time in the making. So don't think the Fed's going to pivot and everything's going to be good again, because what history tells you is it's not. Okay. Again, I want to always end on a good note, not a good note, but a positive note. Again, I keep talking about small caps. Let me show you what's going on with small caps. Here's some factors that are affecting small cap stocks in a positive way. We have, obviously, this is obvious. Low valuation small caps are significantly outperforming high valuation. Also, high dividends. strong momentum, earnings revisions, all this makes sense. The one thing that doesn't make sense is high beta, which is pretty surprising, but it isn't in the sense that most small caps are less liquid and are probably more high beta than large cap stocks. But the bottom line is, folks, if you're going to get into the stock market, if you're looking for opportunities, valuations, you have to look overseas and you got to look at small caps in the US. That's where the value is. And you've got to buy individual stocks. Forget about ETFs and funds. Do some homework. If you're really interested in investing, I know a lot of you are, do some homework. Yeah, there are some good newsletters out there. Grid Capital is one. You can always go to Stockmo. He talks a lot about stocks. I'm not going to give you any stock picks. We're macro guys. We're helping you understand the situation. But if you look at opportunities, again, look at emerging markets, look at overseas, look at Brazil, even China to a certain extent. Find the good companies, U.S. small caps, find good value. And as always, investors, be careful out there.